What are you telling us this morning? A bunch of folks are retiring all at the same time?
Yes, sir. It's been happening since COVID. And it was expected that this kind of mass retire would slow down, but it hasn't yet. COVID obviously put a lot of people in a place where, they feared for their own personal health in trying to serve people. It was older people particularly that were most affected by COVID. So if somebody already was developing health issues and they were putting off retirement anyway, now it was a prime time for them. And maybe 2 or 3 years of that created a shift. If you're sitting there and you're 60 years old and you see all your friends retiring around you, all of a sudden you start daydreaming about it. There's one thing I've noticed. Almost without fail, if I hear somebody, when I ask somebody, hey, when are you looking at retiring? If they say let's say 1 to 2 years, 1 to 5 years, even if it's 1 to 7 years, if they say 1 within their mindset, I'm going to hear from them within a year. I'm ready to retire. That's just once you start thinking about it. So I think part of it is so many people have seen so many other people retire. And so many of them retired earlier than what they expected. We've had more people retiring at age 62 than we've had in a long, long time. And it's continuing. Well, there's something else that's going along with that at the same time. What generation of people are retiring right now? Baby boomers, right? Which is our largest population. So this begs the question, what kind of impact does this mass retirement of our largest population, what kind of impact does that have on the stock market and your investment future?
And you would think, even me, you would think a number of folks like that, all retiring at the same time, you would think that would be easy 2 + 2 math.
Well,
it puts a strain on the system, right?
It does. It puts a strain on the system. And I'm going to do a little bit of a history lesson here because there's something that happened in 1980 that pretty much changed the course of the stock market and investment. And it was 3 things that happened almost at the same time.
And I did all of them.
It was you. It was you.
I remember 1980 very well. Yes. But something tells me I wasn't involved in what you're about to tell us.
So what you were?
Oh.
How old would you say you were in 1980? Probably about 22. Is that about right? Yeah. I guess so. Somewhere around in there. And you're a part of the baby boomer generation, right?
Sure.
Okay. So that's what was happening. All the baby boomers were coming to the age when they were going to start putting away for retirement. Second thing
that's one thing I didn't do. Of all the things I did in 1980, that is one of them that I didn't do.
Well, we all have our own path. I would say when I was 22, I was not doing anything like that myself. I was investing in other things that definitely did not, they could have shortcutted my future. But that being said, the people were coming of age when they were starting to put into retirement. In 1978, something was created that had never existed before and would change the world. Me. No, I'm just kidding. It was the 401k. Okay? The 401k started in 1980. The third thing that happened is we had record high interest rates. If you may remember, or some of you that are listening, if you were buying houses in the early 80s, you may remember home interest rates as high as 20%. I like to do a thing every time I do a workshop. I say, who had the highest interest rate in here? And just the other day, somebody said 20%. And it's because interest rates were super high. They got as high as 15.5%, which then, of course, your mortgage interest rates are usually going to be a bit higher than the highest Fed percent for interest rates, as far as they're concerned. So we had super high interest rates. We had the creation of the 401k, and we had the largest population of Americans coming of age to start investing into their retirement. What the 401k did was it allowed for the first time your everyday Joe to just take their extra money and put it into the stock market. And it was at a time when taxes, so I guess there's a fourth thing, I guess I never thought about it this way. Taxes were also at 70% on the top tax bracket. So taxes were super high. So you have this new tool where you can avoid paying taxes while they're super high by putting them into a 401k. And so people are excited to be able to contribute into the market. Employers are excited to have their employees put into the 401k. Do you know why?
Why?
Because before that, the primary retirement tool was a pension. And the pension is a future risk for an employer because he is promising you today that in 40 years that he's going to pay for your living for the rest of your life.
Yeah.
What if instead he was able to say, hey, you know what? If you put 5% in the 401k, I'll put 5% in the 401k. Now, that's today's risk. He can budget for today's money a lot better than tomorrow's money. So the average everyday Joe is excited to invest in the stock market. They're excited to get a tax break, and they're excited, and the employers are excited for them to do it. So they're happy to give the matching. So because of this, we had the largest explosion in stock market growth in history. You can actually take from 1980 to 1999. You can take that 20-year period and compare it to every other 20-year period all the way back to 1900. And none of them had the growth of 1980 to 1999 to the degree that you can add up all those times together. And so, in other words, from 1980 until now, from 1900 until now, their total combined growth is still less than the amount of growth we've had from 1980 to 1999.
Yeah. I'm thinking way back then, though, you talk about this pension thing. That was a risk for the employer because, all right, so you start working for Joe Blow Enterprises when you're 22. Who's to say they're still going to be around?
That's right.
In 40 years.
That's right. And so that's another motivation for these young investors to put into a 401k instead of a pension, right? Because then they feel they have a little bit more control. Well, but here's the thing that people didn't realize and didn't think about. And it's taken years to kind of understand this, is that the person, if you have a pension, which is basically an insurance policy that the company buys that on your, how long you live, you're going to get a guaranteed income. Social Security is a pension policy, or, they're known as annuities. That's what it was doing, right? What happens now is you as the investor, you as the saver, when you retire, whether or not your money lasts you the rest of your life is on you, right? So there are all these variables that can affect your retirement. So if all the baby boomers coming into the stock market all at the same time can have the largest explosion of growth in the stock market ever, then what kind of impact would you say all of the boomers coming out of the workforce, no longer contributing to the stock market, but now beginning to draw from it? Could that also have a negative impact of the future of the stock market investments?
Well, yeah, because they're just constantly pulling out.
Right.
Of it every month.
If you look at the actual growth from 1980 to 1999 and compare it from 2000 till now, you see this kind of overall steady growth from 80 to 99. It's a little up and down, but it's relatively smooth. But you compare it from 2000 to now, and you have big ups and downs all the way through. We lost for 3 years from 2000 to 2002. We lost for a year and a half from 2007 to 2009. And then just in 6 weeks with COVID, we lost 37%. So not only are we losing more, we're losing faster. Now, we also have a lot of growth, but for somebody who's 20 years old right now, Believe it or not, that's a wonderful thing. If you have a lot of volatility, that's great. That helps you because when the stock market's down, you're buying stocks on the cheap. When it goes up, it allows that to expand, and you wind up with a pretty good growth overall. Are you going to see what you saw in 1980 to 1999? No, but the volatility doesn't hurt you the way it hurt somebody who's moving into retirement. Okay. So that's the problem that we're facing, is that we do not know what the next 10, 20, 30 years is going to look like. But what we can know is that it's a lot more harrowing than when most of you who are about to retire was coming into the workforce. And so you have to have good strategy. The old adage of just put it in there, let it ride, the money will always come back, doesn't work that way anymore. Yeah. Okay? The other thing that happens is even for people who were retiring back in the 80s and 90s, they had great retirements because they were able to do what was known as the balanced portfolio, which came up in the 90s, which is a part of that incredible growth period, where they were able to balance the stocks against the bonds. And they did a pretty good job of balancing each other out. But that was because every time the stock market went down, the government would lower interest rates so that people would spend their money more. Well, when interest rates go down, bonds go up. So the stock market goes down. The Fed raises interest rates, which causes lower interest rates, which causes bonds to go up. So when the stock market went down, bonds would go up. This worked well until 2019 when interest rates were nearly zero, okay? And they couldn't go down anymore. So now interest rates have been going up steadily. Stocks and bonds portfolios don't work the way they used to. So much has changed from 1980 till now that we cannot continue to invest and put our money together the way we used to, and we have to use new strategies to help. Should you still have some of your money in the stock market? Absolutely. But you need to have a new way of balancing that's going to make sure that the volatility in both stocks and bonds will not train wreck your retirement. That's a really long explanation as far as why a careful and new approach that you may not have done before is super important for you in your retirement.
Very good. So having said all that, then, if you don't have a financial advisor or anybody like that, Seven Waters Advisors, good folks to call.
Well, yeah, the first thing we do is we get together with you and we look at what your portfolio looks like. The first thing that you want to know is how much money can I make in retirement and still have my money last me the rest of your life. We have a program that shows you exactly how much you need to get back in retirement. And what this does is it clearly shows you what you can expect to earn. And I will tell you, I've had several clients who, number one, were overly optimistic, and when looking at their numbers, realized that they had to adjust some of their expectations. On the other hand, I've had even more clients that were actually afraid they were going to have to take a huge pay cut. Like 2 days ago, I had a client. He and his wife are sure they're going to have to take a pay cut, and I showed them the numbers, and they were like, "I can't believe it," because they actually can earn 5% per year for the rest of their life and make the same amount of money in retirement as they did while they were working, and still be able to take cost of living increases from their portfolio and retire with the same amount of money. Be at 95 with the same amount of money in their portfolio as what they retired with. So if you know what your target is, you know what to expect. And if you know what to expect, you can make your plan and start your investments. Most people who are setting up your retirement, they try to tell you, how much can I get you? Well, sure, if there's a way to get higher numbers of return, but you're putting yourself at a higher risk. The question is, how much do you need? Because when you're young, it's about how much can I get? Because you're trying to build that nest egg. When you're about to retire, it's what can I make sure that I can rely on and keep my quality of life without it going away. So, Warren Buffett always says, you're insane. You're insane if you risk what you do not have. Risk what you already have for what you don't need. And so many people, once they're retired, they don't know that they have enough to live the rest of their life and get a conservative return to protect their assets. And so they still do the riskier portfolio, and they wind up broke or leaving their wife broke when they pass away. And we want to prevent that for you.
And to make an appointment with you,
903-730-6688. Again, that's 903-730-6688. Or you can go to our website, sevenwatersadvisors.com. And that's the number 7. 7 Waters, and Waters is plural, 7watersadvisors.com.
working today? You got appointments today, or you?
Oh, I am slammed all day. Yes, sir.
Really? All right.
Maybe that's why I'm talking so fast. I know all the appointments I have ahead of me.
Well, there you go. Okay. All right. So you have a busy day.
I do. Yes,
All
sir.
right. Well, good deal. George McFarland, 7 Waters Advisors. I appreciate you coming in here this morning.
Absolutely. I love being here, Mark. Thank you.
Appreciate that. Sunday morning, what's the big topic?
The big topic is the one investment that can make you or break you.
Which one is that?
You'll find out on Sunday.
Oh, okay. And then we'll embellish more about that
Absolutely.
next week.
Yes, sir.
Okay, very good. Thanks, George. 7:15.